Private debt encompasses unrated and unsyndicated debt products. So essentially, insurance companies and pension funds with long-term fixed liabilities are looking for long-term assets to match those liabilities. We look at private debt in terms of the speculative grade space, so double B, single B. In the double B space, we see European private placements, which is primarily an insurance product and an unleveraged product, and with returns in the less than 5% area. In the single B space, we have private debt for large syndicated financial sponsor or leverage buyout transactions. Those tend to be in the high single B category, and then in the smaller single B category, for smaller leverage buyouts, we have private debt in the form of what we call unitranche. So small facilities that are all senior, and they blend senior and subordinated debt pricing into one facility, as opposed to a borrower going to a bank and receiving a senior facility and then a subordinated debt facility that's much more expensive. So unitranche is designed to give you more seniority at lower cost than a senior and a sub transaction, but more leverage on the senior side than on the senior transaction. The players tend to be large global platforms, so typically a credit fund from a private equity firm like CVC Credit Partners or Bain Credit or GSO from Blackstone. And they tend to have large funds, over $2.5 billion, and they can underwrite large transactions and simplify the M&A transaction or the sales risk for a large sponsor. Whereas smaller funds, say up to 500 million, they tend to focus on the smaller transactions, which are much more competitive and generally see more erosion in the risk-reward profile.